this section, ladies and gentlemen, is the most important part out of the framework discussions. Here we're going to look at the definitions of elements, assets, liabilities, equity, income, and expenses, as well as when you can recognize them, put them into the financial statements. There we're going to look at recognition criteria. So let's get going. First up, what are financial statements? Just remember that there's a difference between recognition versus disclosure. I'm going to address that in a second once I explain what's in a financial statement. So the financial statements, first and foremost, have the statement of financial position. You've often heard this referred to as a balance sheet. That's the old name. Then there's a statement of profit or loss and other comprehensive income. This we used to talk about an income statement. Then there's a statement of changes in equity, a statement of cash flows, and last but definitely not least, there are the notes to the financial statements. Now, when I'm talking recognition, when I say recognition, I go and I actually pass an accounting journal. I put my figures into the pastel bookkeeping system, and it comes out in the statement of financial position, profit and loss, equity, as well as cash flows. But when I'm talking disclosure, it is not recognized in any of those statements. It's only in the notes. Okay, so please understand the difference between recognition in the balance sheet or in the financial position and profit and loss. If it's disclosure, it's only in the notes, right? And the notes are there just to describe and add on to the actual statements of financial position, etc. So what's important to understand is we've got two concepts here within accounting. We've got financial position and financial performance. Now, financial position is what we call a wealth concept. Okay, so if I look at it, I've got a pile of cash hiding in the bank. Okay, that pile of cash has been accumulated since the day I was born, and it's built and built and built year after year after year to give me a total amount today. Okay, so it is cumulative. What's very important is this is going to link to the statement of financial position, obviously, and you will see it. We always talk about in the heading ABC Limited Pty, financial position at a specific date. So there's no beginning date. The beginning date was when the company was incorporated, and it's everything, all the assets and liabilities up until that reporting date. That is quite different to financial performance. Financial performance is an income concept. It's done over a period, right? So it's done for a fixed period, and our statements of profit and loss and other comprehensive income must illustrate that. It'll say profit or loss for the period ending 30th of December. So here we're going to have a beginning and end, and it's for that period. Whereas financial position wealth concept is from the beginning of time for that company all the way up to a specific date. Now, it's important to understand this because when we talk about elements, we are going to split elements, okay, the what in the financial statements into both of these, a financial position elements as well as financial performance elements. Now, the financial position elements are going to be assets, liabilities, please write these in on your notes, as well as equity. When I'm talking about assets, I want you to think about benefits. Okay, cash brings benefits. If I have a debtor, if someone owes me money, that's a benefit. They're going to give me cash. If I have a machine that I'm using to manufacture stock, well, that's a benefit because the stock will come out, get sold, turn to cash. Okay, all those are all examples of assets. Liabilities are what we will think of as obligations. Yes, these aren't the pure definitions yet, but it's a starting point. Obligations, we owe someone something. Okay, we must perform in a certain way. Remember, obligations require settlement. Okay, so it's not quite is simple, but you've got to think about debt. You always must pay your debts. Okay. Equity is quite an easy definition. We call it the residual interest, which is just assets minus liabilities. Okay. Remember your accounting equation for a second. Accounting equation was assets equals owner's equity plus liabilities, right? Now we're defining each of those, assets, equity, and liability, all in terms of that accounting equation that you learned in FAC1502. On the financial performance side, remember this is done over a period. We're going to have income and expenses. And for both of these, remember, when they accumulate into equity. Okay, so every year for that period, we have a financial performance. Okay, income minus expenses becomes part of profit. Profit then goes to retained earnings, which is equity. Okay, so they fit together, guys. Everything in accounting is a piece of a puzzle. How do I define income then? Well, along with an income, either there's going to be an increase in an asset or a decrease in a liability. There's one scenario where that happens where it's not income, is where companies issue shares. Okay, then there's a direct transaction with a shareholder. That's not income. Okay, that's equity by itself. Expenses are the other way around. When I pay out cash to pay salaries, well then the asset of cash or bank goes down. Or maybe I've had to borrow money to make the payment, then there would be an increase in my liability. Okay. That's all this does, ladies and gentlemen, is provide definitions. The framework provides definitions for each of these different elements. It then goes on to tell you when can you put those elements into the financial statements, and that will be once a definition is met, but then there is also 2 recognition criteria. We will deal with that once we finish with definitions properly. So I've given you a very basic concept of definitions, being benefits, obligations, residual, and the income and expenses. But what I need to now do is give you the formal definitions. You need to learn these. You will use these in second year, third year, honors, masters, the rest of your life if you are staying in accounting. So let's start off. I'm going to use my magic pen just to make sure you are focused on what I want you to be. Let's start with assets. Assets are a resource controlled by an entity resulting from past events with the expected inflow of future economic benefits. So that's very important to understand. Let's quickly discuss that. What is a resource? A resource is any benefits or gains we're going to make, right? Possibly in the future. It's important that they need to be controlled by us. So if I've got a river that runs past my farm, is that a resource? Yes, because I can pull the water out, I can irrigate my farm to grow crops, okay, which I will then sell and make a profit. But do I control that river? No, I don't. Okay, so I can't control, and what do I mean by control? Can I restrict others from accessing that resource? With a river, I can't, ladies and gentlemen. So it's not controlled by me. Therefore, it's definitely not meeting the definition of an asset. The next thing that's very important is that the resource must have arisen because of a past event. Usually it's a contract or some type of agreement that gives rise to that past event, but it can't be I'm going to sign a contract in the future to manufacture a train for Transnet and therefore receive money. That's a future contract. It hasn't happened yet, so I can't recognize it as an asset. And the last thing, there must be a future inflow of economic benefits expected. So I've gone to Transnet. I've agreed to sign a contract, and I have actually signed the contract, which makes me able to manufacture a train for Transnet. For the manufacture of that train, I'm going to receive money in the future. That's a future benefit. Okay. What do I have? I have a, what guys? I have a future benefit from a past event from which a resource has arisen that I control. Okay. Now, it's going to be a bit tricky, but make sure that that's in the back of your mind. Liabilities up next. So a liability is a present obligation resulting from a past event, and there's an expected outflow of economic resources to settle. So where this is different to an asset, first of all, an asset was all about future economic benefits, where a liability is all about future outflows. But what have I said? Liabilities you're going to think of as an obligation, but it must be a present obligation, please. Which means there must have been a past event. Okay, so along with the contract that you signed, you have an obligation to behave in a certain way. So if I've taken a loan from the bank, okay, as soon as I sign that contract and get the money from the bank into my account, I have an obligation to pay it back. What is the past event? Well, that is me signing the contract and taking the money from the bank. Quite simple, right? In the future, I will have to settle that with an outflow of future benefits. Okay, equity, I just want you to think of equity in terms of your accounting equation, assets minus liabilities. Okay, that comes from your original accounting equation, which is assets equals equity plus liabilities. If I reshuffle that, I get my equity equals assets minus liabilities. That's basic maths, you must be able to do that. Income, as I said, either an increase in assets or decrease in liabilities, other than contributions by equity participants. So if it's a transaction directly with a shareholder, so I issue a shareholder shares, I receive money, my assets go up. But that's not income, okay, it's specifically excluded. Other way around for expenses, an increase in liabilities or decrease in assets, other than transactions with shareholders. So if I pay a dividend to a shareholder, well, ladies and gentlemen, that's not an expense, right? That's just a decrease in equity. Okay, so definitions, you must learn, you must know off by heart, please. What I need you to understand is our accounting and the IFRS prioritizes assets, right? So you first, if I look at a journal and I go debit asset, okay, let's say I purchased an asset on credit. I purchased the asset nice and easy, right? I first look at the definition, and then I look at the recognition criteria, which I'm going to do with you next. Okay. If I say yes, I put the asset in. If I had to go and say it does not meet the definition, then this is probably not an asset, it is probably an expense. Okay, so first, try and define the asset or liability. If the debit that you wanted or you thought was an asset doesn't meet the definition and recognition criteria, then you need to think, what else could a debit be? It might be an expense. Okay, but how do we define an expense? There's an increase in an asset or a decrease in a liability. So, well, sorry, an expense is a decrease in an asset or increase in a liability. Therefore, the other side here is an increase in a liability or a decrease in an asset. Okay. Now, these recognition criteria. This is answering when can I recognize that element. Okay. First, must meet the definition. I've made that clear. If it doesn't meet the definition of an asset or liability, etc., you cannot put it into the statement of financial position or any of the other statements. Then, if it does meet the definition, you will look at the two recognition criteria. First of all, it is probable, and probable here means more likely than not. Okay, slightly different for assets and liabilities, but a future problem we'll discuss. But I need the probability, so at least greater than 50%, right? That the cash in the future or the benefits in the future will either flow to my business or out of my business. If it's flowing to my business, I'm talking asset. If it's flowing out of my business, I'm talking liability. But that element must also have a cost or value that can be measured with some reliability. We know there's estimation here, right? But I must be able to make a reliable estimate of any cost or value attached to an asset, liability, etc. Okay, so guys, we've looked at the elements definitions and recognition criteria in detail. You must learn these, okay? I need you to be able to list all of those, learn them off by heart, make sure you can write them down at 2 o'clock in the morning, okay? As well as the two recognition criteria right at the bottom here. If you don't know those, you will not succeed in accounting. Go and learn them now, please. Thank you.